Well, good evening, everyone, and thank you so much for joining us for the seminar this evening. It's our first of 2025, so Happy New Year. And this title is the title of the seminar for tonight is A New Year in Real Estate. Special thanks before I go into the slides to Jordan Levine. He is the Senior Vice President and Chief Economist at the California Association of Realtors. So he gave a presentation to our local association on Tuesday, and so I'm borrowing some of his slides as we go along. So just launching right in 2024, how did we do in terms of a market, in terms of the real estate market? Usually I always do a market update at our seminars. And so the first one that I always have and that I'm including here is our median sale price. This is the median sale price for 2024. And as you can see, it's pretty steady along the way. This is for single family homes in San Mateo County. And as you can see, that big bold mark across the top, the horizontal line, that is the $2 million mark. And literally across the year, it has been kind of up and down over 2 million, over and under $2 million. In May of 2024, you can see this peak here. That was an all-time, all history, all-time high of $2.3 million. And just to back that up, to back up a little bit, median sale price is basically the price at which same number of homes selling above it. You have the same number of homes selling above that price as below it. And it's pretty amazing if you think 2 million. So despite all the whatever ups and downs that we experienced, it pretty much kind of plateaued around the 2 million mark. Again, a little above, a little below it. It actually breached the $2 million mark three times over the course of the year. So that was once in January and then in November. So just something to note. Taking it back a little farther, so I went back to 2010. And you can see, in 2010, we're looking at around a $500,000 mark. And then, we've had, as always, the ups and downs along the way, but it's almost as if you can draw a straight line here, a lot more volatility after COVID, because 2021 years we had, a peak at that time as things freed up. And then we had the interest rates all of a sudden changing. And so then we saw some amount of a dip over the latter half of 2022 as well as 2023. And then 2024, we do see again the all-time high that happened in May of 2.3 million, and then it kind of came down a little bit and has been adjusting around ever since. But it's almost as if you could draw a straight line, right? Even considering COVID, that you can draw a straight line just trending upwards, so that where we started at in around 2010, in 2010, around $500,000 has quadrupled in the last 14 years. Another way to look at it, and this is from CAR, actually the California Association of Realtors. They did a breakdown here by year. So this is going back 2015 and average median sale price for single family residences. It started 2015 at 1.25 million. And for the whole year, whole of 2024, we were at 2.1 million. So, almost, not quite, but almost doubled just over the course of those years, the last 10 years. Uh, so that's pretty impressive, right? One of the major factors of that has to do with inventory, and I'm sure, those of you who heard my seminars have, heard months of inventory. Basically, this is a metric where we measure if you were to take the number of homes that are currently on the market, don't add anything else, and then just sell them out, right? Sell them all at the rate at which they're selling now. What do you end up with? And how many months can you last before you completely run out? Traditionally, you can see this top horizontal line. The balanced market is 6 months. So that's this vertical axis. 6 months is the point at which they say we have a balanced market between a buyer and a seller market. If you go above that, you're more like a buyer's market because there's a lot of inventory. It'll take you a longer time to sell out. And if you go below that, then that's traditionally considered a seller's market. In some cases, people will say 5 months is more like it, but regardless of how you measure it, you can see that starting 2012, So it's been a good 12 years now. We've been basically hovering around the 2 month mark. And so that is severe, very much in a seller market territory. Of course, there are, different factors like specific location, condition, etc. But we've had pretty much bouncing around the 2 month mark. In 2017, 2018, we're at the 1 month levels. In 2021, as well as beginning part of 2022, again, 1 month level and even below at some point. So that tells you really a lot of the inventory pressures that we've been facing over the last 12 years. I started real estate in 2008, and that was when we were having the Great Recession. And you could see even in 2010, 11, there, it was a little, you had a lot more inventory. At that time, I was going to seminars, and the economists were all saying we're not building enough housing. And we're going to start seeing the impacts of that in the, not too distant future. And sure enough, over the last, 10, 12 years, we've had a shortage of inventory. So that's a huge factor. Number of sales is another way to measure it. And I'm not going to go into all the direct exact numbers here, but going back 2010, you can see it goes up and down. That's mainly because of seasonal trends. So near the end of the beginning of the year tends to, go down a little lower. It doesn't go to zero, but it does reduce in terms of the number of new listings, number of sales. What I would point out though is that when you see 2022, these are these last three, right, toward the last three peaks that you get, 2022, 2023, 2024, they're all significantly lower than what we saw in the previous years. And this is, this is so this is really indicative of the number of sales have been low. This is true nationally as well. So 2023 and 2024, usually you'll get something like 5 to 7 million home sales as a total. Nationally, in the previous years, in 2023, it was well below 4 million. So it was about 3.8 million, I believe. And then for 2024, they were projecting, and the numbers haven't come in yet, but they were projecting it to be maybe somewhere around 3.9. So still below 4 million, and that's nationwide. But then in our area specifically, we've seen, it's quite a lot less, right? So again, that's another way of looking at the inventory and seeing how our sales have been down. This is from seven. This is another way looking at it in terms of average per year. So I mean average per year exactly. And so we can see here where you have that trend. 2021 did go up quite a bit in terms of number of sales, and then 2022 came down a little bit. Most of the sales were toward the beginning of the year, and then that started to slow down a bit toward the end of it. And then we saw 2023 was actually a really tough year for many people, for many of the real estate agents, because just the number of sales was down significantly. Uh, and then 2024, a little bit of increase, but still pretty challenging. So it's been a challenge overall just to see for buyers and especially and for realtors as well. This is a look at California sales on a monthly basis. You see the little bars. The colors are designating the years. So we go back to 2020, the COVID years. So the very beginning of the year, you saw a little bit of a part of a seasonal trend, part of it the impact of COVID, and then after that it took off. So we had peak times in 2021, and this is for the state. 2022, again, you start seeing that decrease over the year. And then 2023 and 2024, if you just looking at it, you can tell they're like almost half of what were at least 60%, 60, 70% levels of what throughout the state we're experiencing in terms of closed sales. So that reflects also on the days on market. This is another metric that I like to look at, which is how long does it take when you put a house on the market until it sells? For those of you who've been looking at houses, you'll know a number, they call it DOM, that's days on market. So it's just taking a look at that. Again, in 2010, 2012, we were getting, between 20, 30 to 50 days, which was almost 2 months, 1 to 2 months was not that uncommon. By the time we hit 2012, this lower bar here, lower horizontal line is 10. The second one above is 20 days. And so we saw the days on market levels pretty much in the teens. There were, and usually the peaks that you see are going to be more toward the end or beginning of the year. Again, just because during those times, activity tends to slow down a little bit. The red line here is zero, and that's not because things were selling in 0 days. It's because of the COVID lockdown, the MLS, the multiple listing service, temporarily paused the meter because when I think it was March 17th, 2020, we had the lockdown statewide, we were not allowed to have open houses to show houses. And so it just didn't seem really accurate to be able to say a house had been on the market for a certain period of time when you can't even show it, right? So it didn't seem fair. So MLS chose to pause the counter a little bit and then started it back up again in May. So that's where you see the zero here. But other than that, you can see it pretty much hovering around the 10-day level. So you literally have one weekend of open houses or maybe two, and then that's it. So you would get an offer and go into contract. So you do again see some peaks that go up to as much as 30 days. And this is really toward the end of 2022 we began to see some of a softening of a market a little bit. It would be more challenging. You would still get houses that sold quicker, but there were more that were taking time. And then in the last 2 years, we've seen it again back to those, between 10 and 18 days at max. So the low inventory levels, the inventory has really made that impact on homes just selling very quickly. And I feel almost as if I could uh, take a market update that I did like a year ago, and it would be almost the same thing. So we've been experiencing that, or even farther back. Besides inventory, the other factor that has been really big in determining, our in terms of driving our activity has been interest rates. So this is a chart that goes all the way back to 1971. What you see is the 30-year fixed rate mortgage. That's the FRM, 30-year fixed rate mortgage. What's the average? And as you can see, it started coming down, we're with fears of recession, et cetera, COVID and whatnot. So we were actually in, the 3% range, 3% or so. And so we saw that. And then toward the end of 2022, and toward the middle of 2022, all of a sudden the rates started going up. And so within a matter of months, we would see rates where we were hearing about 3% or so. Now we're talking about 6% and even 7%. And so over time, that really is what the factor in terms of our prices going down a little bit, taking a little longer to sell. Um, all of that, even with the low inventory continuing on. And then so then we have where last week, as of January 9th, the interest rates have been around 6.93% as an average. There have been some adjustments along the way, but that is that has been really playing a factor for us in a couple ways. In terms of buyers, it's a factor because it reduces their buying power. If you have a interest rate that was at 3%, you were qualified for, you would really have to be careful if now all of a sudden it's at 6% or 7%, because every percent can impact you by about, depending on the price point, but by about 10% in terms of your buying power and what you can afford. And we were seeing within a matter of months, again, going up to that 6%, 7%, almost flirting with an 8% range as of the end of 2023. And that was what was really starting to hamper sales a little bit and cause some more challenges. Housing affordability. So this is just taking a look at since 1984, and this is for you can see the green on top is U.S. Affordability Index, and then the orange mark below is California because our prices have been higher. And so in general, if you take that combination of the interest rate plus the price, just the price of things and then the income, the median household income, you can see here that it actually peaked somewhere around 2012, since 2007, we have the lowest affordability right now. So we're at, as of Q2, second quarter of 2024, and it's pretty much kind of stayed the same or probably gotten worse. We were at 14%. So in terms of how many people can afford to buy a home now compared to their income and whatnot, in California, 14%. In for the US, 33%. So that is quite low. In general, for the US, it's been more like around the 50% levels or more. And then for California, it's always been lower, but still around the 30% range. And so now, again, that combination of the prices continue to go up because of inventory, and then also the interest rates going up, and the more than anything, the median income not being able to keep up with that. And so we're seeing really it becoming a challenge in terms of what has been happening. For sellers, it's been actually not bad, because the median sale prices continue to go up. For those who are trying to do both sell and then maybe buy up or buy down, to be able to buy a bigger place or a smaller place, it is a challenge because of the prices just have gone up so much. I was actually Jordan Levine, who is the chief economist at our California Association, was mentioning that he had sold his home, a single family home, and then was buying a condo, downsizing into a condo, and his payment is pretty much the same, right? And so it was like that, and so that's difficult, but he needed to do that for his personal reasons because that makes sense. But in terms of affordability, it's actually become quite a challenge for first-time buyers, especially, and then even those who are looking to either move to a bigger place or a smaller place, it has been a consideration. So with that, 2025. So what does 2025 have in store for us? So some factors to consider, some of the different things that can impact our projections are inventory levels. So, what are we going to see with inventory levels? And the thought is that most of the economists out there are predicting that inventory levels and home sales will probably increase slightly. Okay, that we'll start seeing a little bit of a change in that, but they're still going to remain at historically low levels. So we're expecting it to do that. Hopefully, we've hit a little bit of the bottom. Some factors with that, the lock-in effect. It's and other Some of you may have heard me talk about this before. According to newly released third quarter data from the Federal Housing and Administration, 73.3% of US mortgage borrowers currently have interest rates below 5%. So 2022, this was even less. So there were 85.5% of those who have mortgages had a mortgage rate below 5%. Now that's easing up a little bit, but it's still 73%. And so this lock-in effect is where basically somebody is saying, hey, my mortgage right now is 3%, or mine personally is 2.65%, right? So if I'm going to move, now I'm looking at a 6%. I'm almost doubling the mortgage rate at which I'm borrowing, and so that's going to make me consider moving a little less, right? And so it locks homeowners into staying longer where they're at, because to go anywhere else, if they're going to need to borrow money, it's going to cost them more. We are seeing that's pretty high still, 73.3% having a below 5% mortgage rate, but it is easing up a little bit because we are seeing some decline from 2022 levels, because more and more people are getting used to it and starting to get new mortgages that are higher than 5, that are more like the 6 or the 6.5, and they're getting accustomed to it now and having that expectation. So it's being relieved a little bit, this lock-in effect, but it's still very much a factor. Another factor is this idea of aging in place. And so a survey from AAG is talking about, said that 92% of seniors prefer to live their later years in their current home rather than move to a facility. And there are some other stats here, about 40% of seniors feeling that independence is the most important benefit of continuing to live at home. 56% say that their home reminds them of their family. 83% feel safer at home, and this really was exacerbated through COVID. As you know, I'm sure all of you are, kind of remember those times when we were seeing videos of older residents of senior facilities. They can't see their loved ones. They're kind of trapped there. It was a very, depressing image that was burned into so many people's memories, and so we did see an uptick after COVID of more seniors who want to stay in place longer. And that's great, but then it also reduces inventory, right? That keeps the inventory, locked in with people staying in their homes longer as a whole. Another impact is California residential building permits. So less building. So not only are people who live in homes staying there, there have been less building that's been going on. So this goes back to the 1970s, and you can see just how since the 70s there was really a boom of building in terms of residential buildings. That continued through the 1980s, went down quite a bit in almost half in the 90s, did come up a little in the 2000s, and then it's been down to where, in the 2010, 851,000 building permits that were issued. 2020s are not done yet, but it's still pretty low so far. Other factors to continue, so the inventory levels, as I mentioned, mortgage interest rates. So what are those going to do? I'm sure all of you have kept up in the news in terms of, hearing what the Fed is going to do. Every time that they lower rate, they talk about the Fed lowering rates, just to keep in mind that they are not lowering the mortgage rates. They're lowering what's called the Fed funds rate. Okay, so you can see here, these are the projections from CAR in terms of 2024, the Fed funds rate was at 5.1. It went down to, the projection is that next year it will go down to 4.1. Sorry, missing some of the there. So you can see this is a June meeting, September meeting, December meeting, and then you can see how it goes from 4.1 to 4.4 and 4.4. That's what happened in 2024. They are expecting at the June meeting coming up, maybe around 4.1, and then continuing over the long run. So 2026, 2027, maybe continuing over the long run. Of course, these are projections in terms of what may be happening, but we're not seeing a huge drop over the coming year in that Fed funds rate, which is that rate at which banks lend to each other. It can have an impact on our mortgage rates. And so, as you can see here, sorry. So as you can see here, so this bottom bar is the Fed funds rate that we had talked about. There is something called a yield curve, which I'm not an economist, but basically it has to do with what is the factor of what are they expecting in terms of yield for dip bonds at different maturity levels. So the short-term bonds versus the long-term bonds, and what does that yield curve look like? In terms of, are people expecting that the longer bonds will be better than the shorter, that kind of a thing. So there's the yield curve, which can factor into mortgage rates, and then there's a spread, which is basically the gap between the Fed funds rate and the mortgage rate. So with that, 2024 mortgage rates averaged about 6.9%. The expectation, this is coming from CAR, the California Association of Realtors, is 6.6%. And then for 2026, so another year out, we're staying in that 6.5 range, 6.4. And then maybe by 2027 and in the long run to go into the mid fives. Nobody is expecting, I have not heard a single person who said that they expect us to go into the fives by next year. That is the hope for the long run. And there is definitely no one who is expecting that we'll ever in actually, in the next whatever distant future to see interest rates, mortgage rates at the 3% levels, 3 or 4% levels. I have not heard a single person saying that. In terms of 2025, I'm hearing different things, and I'll share some of the predictions with you. But basically, I've heard from some people who are even mentioning that they might be that they might expect that the interest rates will go up next year. Not only will they not come down that much, but they might actually go up. So, but this is the expectation of the of CAR chief economist. So going back to factors considered, we covered interest inventory levels, covered interest rates, buyer demand. So that's another factor, right? Interest rates have an effect on that, on both the inventory levels and the buyer demand. Um, but rates are one thing, but life happens, right? And so as they show here, we have 1.68, 1.7 million births. This is in California. So between 2020 and 2023, we don't have the numbers for 2024 just yet, but between those 3 years, within those 4 years, I guess, 1.7 million births, 1.2 million deaths, immigration, 282,000, and then out migration, 1.1 million. So it looks as when you see it here, it's a net decrease of 420,000. In terms of sales, the births don't necessarily mean a sale, but it could be because as the families grow, a lot of times you'll have people who need to find a bigger home. Right? So there's that. Deaths definitely, I mean, even when there's low inventory levels, a lot of my sales, I continue with sales because, people passing away. And so now the family home needs to be sold. So there's that. Immigration, new people coming in and out migration. You have people who have been leaving, especially with remote work available, although that has changed a little bit over the past year. Some remote work available and different reasons, people feel like it's just too crowded here. Life happens, and so sales happen as a result. And I think that's one of the interesting things for me being in real estate. I actually get to see a lot of the life changes that are happening with people because that's when when they need to move. And so whatever the interest rates are doing, if you need to move, you need to move. If you're going to get married, if you're getting divorced, if your you're having children or your children are moving away, retiring, there's so many ways in which real estate interacts with life. And so again, whatever happens with the mortgage rates, still people move. And so we're seeing that. Although I have had people ask me, well, with the net decrease of 420,000, this is over 3 years, right? Isn't that going to lower the demand for real estate, or we have enough? And so far, still, we just don't have enough homes. So even with a net decrease over 3 years, 420,000 people, it's still we're still looking at low levels of inventory, just not enough housing. And you can see that just in terms of the California government and the local governments that there are things like RENA, the Regional Housing Needs Assessment, that are happening where they're saying we need more homes, and so they're trying to build, but that process is a long process, and so we're still by really limited in terms of having enough homes and especially enough affordable homes for people out there. So, in terms of the economy, right, we see that the headline numbers do suggest a strong economy, and that's partly why we're not expecting that the interest rates are going to come tumbling down over the next few years. We do have a new federal administration coming in, and there are different thoughts in terms of what are they expecting. If there are tariffs that are introduced, what happens? But for now, most people are expecting that we will continue to have a strong economy. We have strong U.S. and California growth. If there are tariffs, incoming President Trump is talking about tariffs. If there are tariffs that are imposed, there are expectations that that's going to cause more inflation. If there's more inflation, then the Fed again is going to have to continue to tamp down on that by keeping that Fed funds rate fairly high. And so we're not going to have, again, a big push down or decrease of the mortgage rates. The good news is that with a strong economy, that means, when we have good job numbers, it's funny because the loan agents out there are like, yeah, when the job numbers are good, it's actually not that great because, it impacts the interest. We know that the mortgage rates will probably stay strong or the Fed fund rate will stay high. But it's good news in the sense that you have people who have money, right? And so we can keep the economy hopefully flowing. I'm not going to go through all of these numbers, but just to show you in terms of US retail sales from 1992, you can see that especially even the brick and mortar, the online has been growing, but if you combine those, it's just continued to increase in terms of retail sales throughout the country. The Dow Jones. So if you have been investing in stocks, you're doing pretty well, right? And so, we're up over well over the 40,000 mark. So there's that just over the years. US real net worth per capita. And you can see that here as well. It just the charts all look about the same, that they're all over the years since 19, this one is from 1959. You can see that it's just continued on that upward rise. And so there is money that is out there. So even with a $2.1 million median sale price in San Mateo County, it can only stay that way if you have people willing to pay, right, for the homes. And so there is money there, uh, to be able to keep those high. So I'll go. So these are the CAR 2025 projections. First, single family home sales to be they were by 2024 in 2024, excuse me, 269,000 home sales. That was up by 4.3% from the year before. And they're expecting that to go up even further by over 10% to 297,000. So again, seeing more inventory coming on, more home sales, being able to see some of that relief coming out there. So 10% more. This is statewide. Median sale price to go from 867,500, extra zero, to 907,400. So about a 4%, 4.6% increase in median sale price statewide. Housing affordability remain at 16%, which is still quite low, right? And then the 30-year fixed rate mortgage to remain in the mid 6% range. So these are the projections. We do know as well in Southern California, there just had, last week just an incredible disaster there, and so how will that impact sales? We just don't know. I think right now everybody's just concerned with making sure that the people there have the help that they need, but it is going to have some kind of an impact in terms of statewide what's going on there. But uh, I think up here, will that have an impact on our sales as well? We don't know. I'm not hearing anybody expecting that to make much of a difference, but I think statewide, definitely the numbers are going to be very different, and it just remains to be seen what happens there. This is a look at the same kind of the same statement, but in a chart for those of you who like charts. And this goes back to 2016 levels. I mean, it's 2016, the year 2016. So single family home resale, we could see 417,000. And they were in the 400s. And then you can see it going down and down and down. Projected as of the time that they developed this chart, which was at the end of last year, of 269,000, so almost half. And then for 2025, maybe be able to have that go up a little bit by, 10% over this year. And then the median price, 500,000 going up to, it's projected to go up to 907,000 next year. It was housing affordability index in 2016 was 31%, compared to a 16% projected for both last year and this year. And then the 30-year fixed rate mortgage in 2016 at 3.6%, going up and then down quite a bit, and then going to 6.6% as the projection for California. I mean, CAR's projection for the coming year. Prices, again, only set to rise further next year. So this orange bar here is 2024, and then expecting that to increase. And again, it's that whole idea of the inventory levels are still low. And the interest rates, even though they're higher than they were in 2016 or 2020, the buyers are just getting used to it, right? It's kind of being factored in already. And so we're anticipating to see some amount of rise. That's a 4.6% for CAR and what they're predicting. On a national level, so NAR, which is the National Association of Realtors, their projections are at for single family homes, a 7 to 12% increase to 4.5 million, as I mentioned. And as I mentioned, for 2023 and 2024, that number was under 4 million. So this is number of home sales, single family home sales. And so they're projecting that we're going to see the levels of inventory going up. Definitely other parts of the country are probably going to experience a little bit more of an increase. In the Bay Area, we just don't have a lot of land for single family homes. And even the building that's happening is not a lot of single family homes, right? You're going to see the multifamily or the mixed use residential happening, multifamily, instead of the single families. But still, they're expecting to see overall an increase. Median sale price to increase 2%. This is nationwide, to increase to 410,000, which is quite a bit lower than ours in California. And then California is quite a bit lower than San Mateo County, right? But they're projecting nationwide a 2% increase, which is less than what CAR was predicting for California. And then 30-year fixed rate mortgage just stabilized near 6% by the end of the year. So they're a little bit more bullish about maybe having some reduction in the interest rates. Zillow, I just pulled because they do their projections as well, and many people look up Zillow. So single family home sales, 4.3 million for 2025 compared to 4.1 million in 2023. I think it was actually less than that, but that's what they had in their stats. And then 4 million in 2024. For median sale prices, a 2.6 increase as opposed to the 2% that NAR had. And then for 30-year fixed rate mortgages, continuing ups and downs through the year, very similar to 2024. So, and we ended up in the high sixes. So they're probably, they didn't put in a number, but it's probably somewhere between the mid and high sixes that they're expecting that we should be at. For Redfin, which they also have their economists that do their projections for 2025, single family home sales between 4.1 to 4.3 million, which represents for them a 2% increase for their calculations. This is again nationwide. Median sale price to have a 4% increase. And then the 30-year fixed rate mortgage to remain near 7%. So to stay in the high sixes, which is very similar to whereas others that we've been hearing. So with that, recent developments in the industry. So change is always happening in the real estate field, and so it's good for everybody to know. And I'm sure you've been hearing things here and there in the news. Um, First and foremost, one of the big changes that happened. So there was a litigation that came out, or several lawsuits that came out from home sellers and some from buyers. Class action lawsuit that was filed not in California initially. So the biggest one is called the Cybernet case that was in Missouri. That came to a settlement early last year, and what that did was introduce. And so those lawsuits were against NAR, the National Association of Realtors, several of the big brokerages out there, and then as well as some MLSs. So what that basically did was there was a suit saying that home sellers were claiming that they were not told, either they were not told that they were paying the buyer's agent commission, and then the other piece is that not only were they not told, but if they were told that they had to pay a certain amount, a certain percentage, or else they wouldn't be able to sell their home. And so that was really the crux of the case. And so with that came a settlement where there were two major changes that were made. One is that all buyers have to sign an agreement with an agent before viewing properties. So all agents need to sign an agreement with the buyer as to, I'm going to be your agent. This is how much the buyer is going to pay. And you cannot even see a property without being able to have that agreement signed first. And that's introduced some challenges because sometimes with a buyer and an agent, you're meeting for the first time, and then all of a sudden, before you even know you're buying anything, you have to sign a form, right? And so that's become somewhat of a challenge out there. Um, the other is related to that, which is talking about buyer agent compensation and how that's negotiated out. And so, just on the next slide, it talks about historically what has been happening. Historically, the seller and the listing broker come to an agreement. called the listing agreement. Within that listing agreement, there's a certain price that you go to, and commissions are negotiable, and they've always been negotiable. So they would negotiate out a price, a commission, and then out of that, they would say, okay, a portion of that, usually it would be a half. You would split it equally, but not always. You would offer something to the buyer's broker, to the buyer's agent. And then that offer would be happening within the MLS. And then the buyer can have an agreement with their broker. So that's not new, but it wasn't required. So, and in previous days, I didn't actually have a buyer sign an agreement with me, right? Because we would start working together. The buyer and their agent start working together, and the buyer can see, and the agent for sure can see in the MLS, the multiple listing service, exactly how much the seller is offering to pay the buyer's broker. Okay, so this is traditionally or previously how we would be. And then post settlement, and there was a settlement that happened earlier last year. It took effect in August of last year of 2024. So post settlement, what happened is now the seller cannot, and the listing agent offer um, cannot offer through the MLS what they're going to be paying the buyer broker. So there are two pieces of it. The buyer and the broker agreement now is requirement before you can see a house together. And in that requirement, in that agreement, you would actually say how much is the buyer paying their buyer broker. The outside of the MLS, the seller could choose to say, well, I'm still willing to offer something to pay for the buyer broker, and then we'll put that into a marketing plan, and we'll let people know, or not. And then what would happen, even if whether or not you have it in the marketing. So if you go to an open house, there are some agents that will actually tell you, or there will be a sign or something that will say, seller is willing to pay X amount to the buyer's agent, right? Um, Even if that's the case, in the contract, now when the buyer is putting in an offer, they need to put in there if they want to ask the seller to pay for whatever it is that they've agreed to pay their own agent. Okay, so you have a listing agreement, seller pays the listing broker what they're going to pay, and then what they've negotiated out, and then the buyer has an agreement with their buyer broker and what they're going to pay them. But then when it comes to the offer, the buyer can go ahead and say, "Oh, Mr. Seller, Mr. and Mrs. Seller, can you please pay this? Can you fulfill my part of the agreement?" Right? And so that is a big change. What has been happening is actually not a huge change so far, but I think we will see changes. I've had about, I want to say 7 or 8 transactions since August, both as a listing agent and as a buyer's agent. And in terms of my compensation, it really hasn't changed over time. And so with my sellers, what I've been doing is basically saying, okay, let's come to an agreement as to how much you're going to pay me, how much my fee is going to be. And then we're not going to actually put out there how much we're going to offer. Let's leave it off and then let the buyer come in with their offer and and they'll ask or not ask, right? For buyers who are getting financing done or maybe don't have a lot of extra cash, the down payment, if you think about median sale price of $2 million, if you're doing a down payment of 20%, that's $400,000, right? So does a buyer have an extra amount to pay their agent? Not always. And so in a way, by asking the seller to pay for it, you're kind of financing what you're paying your buyer's agent. Whatever the case, ultimately, when I talk to my sellers, it's the important issue is how does it net out, right? So if you have an offer that's higher and they're asking you to pay for the buyer's agent fee, or you may have an offer that's lower and they're saying, we'll take care of it. You don't have to pay my buyer agent. What does it net out to? And that's really what's going to be important. And so it's not so complicated. You're adding one more factor in terms of the math, but it's just doing a little bit more math. And for the most part, I'm seeing, and with my networking groups, I'm seeing that not a lot has changed in terms of the numbers that we're seeing. I do know that I am hearing that in areas outside of our area, so more inland areas or maybe even south of us, I am seeing a little bit of a shift in terms of what the buyers and their agents are agreeing to and what the buyers are asking the sellers to pay. So there is some amount of movement around, and I would say, it sounds complicated. It's really not that complicated. It's just a little bit more, we just have to talk more. We have to have our expectations, make sure that we understand, what we're dealing with going in. So again, recent developments, as I mentioned, a buyer signed their agreement, buyer agent compensation negotiations, and then insurance issues is another one. It's not so recent, but really over the past couple of years, we've been seeing the challenges of insurance issues coming up quite a bit more than they were. And especially with what's going on in Southern California, I think the people are expecting that it may be even more difficult to get a new insurance if you're purchasing a home because a lot of the companies have been pulling out of California and they don't want to issue new policies. Last year, I was getting calls from clients every 3 or 4 weeks saying that their insurance company was not going to renew with them. And some of the reasons were very interesting, right? But it was almost as if literally the insurance company is trying to find a way to not insure in California. Part of the reason has to do with the fact that in California, the legislation has been such that the insurance companies are limited as to how much they can raise their premiums. And as a result, they're losing money, right? And then we've had all the natural disasters that have been hit with the wildfires in California, the hurricanes in the East Coast. And so insurance companies, they're not doing this as a nonprofit. They're doing it because they need to make money. And so California has been actually a losing proposition for many of the insurance companies. That is changing. And so I am hoping to be able to get more information where the insurance commissioner for California, in terms of our local MLS, which I'm a part of the board, we're trying to have him come in and uh, give a talk in terms of what's the expectations are. Obviously, they're really busy right now with what's happening in Southern California, but basically the fix is going to be that all of the premiums are going to be able to go higher because one of my colleagues mentioned that California has one of the lowest insurance rates in the nation as a whole in terms of hazard insurance, and so they're kind of going to let that go up a little bit more. So that's a good news, bad news thing where insurance may be easier to find, but as a whole, it's going to be more expensive. How does this impact us? Obviously, if you own a home, it impacts you. But in terms of the purchases, that's something that over the past 2 years, we've had to really bring in to the point where the state actually has introduced a new contingency for specifically for insurance. So insurance was always included as your property inspection contingency. Now there's a separate insurance contingency so that when you're buying a home, you can actually say, I'm good with the property. I just want to make sure that I can get affordable insurance or insurance at all. And so there's that as a contingency. And then your qualification for your loan can actually be impacted by insurance issues because if you have a buyer who is qualified for a mortgage, that's based on a payment and they estimate the insurance payment as well. And then out of that, they say, okay, how much can you afford to buy? And if your qualification is very, they call it the DTI, the debt to income ratio, if that's very tight, if the amount of your payment, which includes your principal, the interest and tax and insurance, if there's a certain amount that they calculate and they take your income, right? And so they say you have to have that limited if the insurance is estimated on the low side and then later you get the policy, you get the quote and you realize it's much higher, now it's taking that debt, that amount of payment that you need to be much higher. And for some people, that can actually push them out of being able to qualify for a loan. And so it's become a real issue. And as I said, just in the past year, the our California forums have actually gone to include now a contingency for insurance. If you're going to sell a home, in a lot of cases, what we're doing is going up front and checking and making sure that they can get insurance. Or even if I have a buyer and I'm going to be putting in an offer, even before putting in an offer, just check with an insurance broker and just see, get an idea, rough idea of how much the insurance actually is going to be, or if you can even get insurance. So it's become a challenge. It's not just in the woodland areas where you have a lot of forests and trees. Sometimes it could be just if you have what do you call it, older electrical plumbing, etc., especially electrical, that can sometimes cause an issue in terms of getting insurance. And again, here you can see percent of buyers who have had difficulty obtaining insurance. And so this left side, downtown and in city, 2023, 6% had difficulty. In 2024, 16%. The next one is city, outside of downtown, the suburbs, rural, vacation or second home. And as a whole, just between 2023 and 2024, there's such a huge difference, right? Where you've had 16% who are having difficulties obtaining insurance in 2024, 31% reported having difficulty. That's a full third, in almost a third of all transactions had insurance become an issue, right? And it doesn't necessarily mean that it killed the transaction, but now the buyers have to come up with more money, have to scramble. I do have a very good insurance broker that I would highly recommend. He's a third generation insurance broker and has been able to help a lot of my clients. But definitely, if you're looking to buy a home, important to look into that ahead of time. For the sellers also, it's good to just be aware of that and maybe just check in and make sure that if there are any safety issues, if there are any trees overgrown in the backyard, whatever there may be, clean up the house so that when the insurance company takes a look at it and they do, that it's not going to cause a problem with the transaction and with you being able to sell a home. So I've gone through all of these. HOAs have been very much impacted, and I'm going to talk a little at the very end about an HOA seminar that I'll be doing. HOAs, condos and townhomes, have been impacted in many different ways. These are recent, especially over the last few years. SB 326 is a required balcony inspection that if you have three or more units with wood elevated elements such as stairs or the hallways, the walkways, they are required every 9 years to have a balcony, to have inspections done by an engineer, structural engineer. If it shows that there are issues, those need to be corrected. And they can't just be, you can't just get a quote. You actually have to have those fully repaired before most of the bigger lenders will lend on those condos. And so that's been an impact. Insurance has been an issue in terms of getting the finances for the HOAs. And I live in a condo, I'm on the board, and our insurance increased by almost 50% just from last year. And so that has an impact in terms of and in terms of the finances and the health of an HOA. Also, the lenders, if you're getting a loan, look at the insurance and they want to make sure that you're properly insured. And there was one condominium complex in the city in San Francisco that they found that they were only insuring about $39,000 per unit, which is there's no way you're going to rebuild a unit for $39,000. So they were severely underinsured, and so that caused a problem with funding. Deferred maintenance, just as much as with the balconies, um, have become an issue as well. And so we're seeing that everywhere I go with the HOAs, if you're buying or selling, you need to check on it. But also, it's possible that you might not be able to get a conventional loan on it if it has these different issues. Also, even if you can get funding, what's happening is that many of the HOAs are having to do special assessments or raise their dues. And so it's not uncommon where maybe a two-bedroom condo, you're looking at like an $800, $900 per month HOA fee, which is it's very common. In San Francisco, it's actually been the HOA fees have already been higher, but now we're seeing that even in San Mateo County and just throughout the state as a whole. SB 326, which is again the balcony inspections, that was the deadline for that was January 1st of this year, and then it has to be done every 9 years. So pretty much every HOA needs to have had it done, and if they haven't, they really need to get that done as well because the lender will ask for those. And then finally, rental market and legislation is another one that's been changing quite a bit over the years. California is now a tenant majority state, and so there are a lot of laws and things that are changing statewide and locally. There have been movements to try to make be able to expand rent control have a statewide registry. There are different laws that are coming in that are really more toward the favor of the tenants. And so I am actually seeing that impacting investors, people who are have investment property in California reconsidering it. And so that, and I've had more and more clients along the way who are saying they're thinking about getting out of the rental market in California and selling instead, just because the challenge of owning a rental property in California is increasing more and more with each passing year. So these are some major developments. As I mentioned at the beginning, there have been lawsuits. There was a major settlement last year, but there are some that are continuing to take place, and I'm not going to go into all of those and the implications of that. But there is a lot that's happening within real estate. And so, I'm glad that we can present these seminars and help keep you up to date. But so before I go into questions, I'm going to go into announcements because I am getting into the main heart of it. But you can feel free to put into the chat if there are any questions on anything that I talked about. But I will go through some announcements if you can bear with me just a little bit longer. I'd like to just really invite you to the rest of our 2025 seminars. And the series for this year is A Home for All Seasons of Life. And what I love about being in real estate, one of the things I love about being in real estate is that it really does touch upon people in different stages of life. And I love being involved in that and being able to help through that. And so with the seminar series, I wanted to have this as kind of the overarching focus. And be able to say, how do we touch upon the different aspects of this? And some will overlap. So if we have something like rental property or something like HOAs, that does impact people who are looking at a first-time home or moving up or and having to sell that home or investment property, retirement relocation, because we're going to have people starting to maybe downsize and move into a condo. So HOAs can affect that. So being able to really have that as the primary focus of the seminar series, that's what I wanted to do. And, we say we want to be your realtor for life. We want to be the one that we can be a resource to all of our clients and friends and community in all the different aspects of real estate. Our next seminar that's coming up, I'm super excited about. It's Navigating Landlord-Tenant Law, and that will be on February 12th at 7 p.m. at the Millbrae Rec Center. So this will be in person. I'm hoping to have it recorded, but I'm not sure. So if you are in the area, highly recommend that you come join us. We always have dinner, and it's a pretty good dinner. Grant H. Baker, who is local, he is an attorney and will be with us to explain and go through really navigating what are the changes from 2025 and even before. So some of the recent things, changes and issues, things to really watch out for. And it is changing every year. There were some laws like last July where it limits how much security deposit a housing provider can request. There are things about emotional support animals and service animals that have been in place for a little while now. And then even this year, more that's coming in terms of when you're moving in, you need to take photos, that kind of a thing. So there's a lot going on. There's a QR code on the screen right now. So if you want to register for that, you can actually just scan the QR code right now and get registered. Otherwise, if you go back to the recording of this, you'll be able to register as well. If you're watching this on recording, you can do that. Um, and then in March, I have the ABCs of HOAs. So that will be on March 19th via Zoom. It'll be via Zoom because I want to have as many people hopefully able to participate in that. So whether you own or live in an HOA already, or you're thinking about buying into one or selling, I'm really going to just go into the whole thing we'll talk about the HOA market because I usually focus on single family homes, but we'll do some update in terms of the condo and townhome market, as well as talk about, what are the things that you need to be aware of. So oftentimes, unfortunately, people aren't aware of what's going on in an HOA until all of a sudden you're getting a special assessment. Or your dues are increasing, and then all of a sudden you want to know. That's kind of late. So it's good to be able to understand, what you're purchasing, where you're living, when you're selling, what are some of the considerations and how is that going to impact potential buyers? So we're going to go through all of that. in March, and I hope that many of you will be able to join us for that or invite your friend if you're not if it doesn't apply to you. And that's true of all of our other seminars. These are tentative dates for the rest of the year. So tax smart real estate investing. So we're going to talk about real estate investing and all the tax implications of that. Investing together, so co-ownership, which is becoming really a trend, growing trend among the younger generation because house prices are really high, and so being able to team up together and join forces to be able to buy uh, homes, whether you're principal residence or investment property together, unlocking the potential of ADUs. And I've done ADU seminars before, but I'm really hoping that not only them as an investment potential, but as people are looking to age in place more, ADUs are a really good option if your home is not, there's a limit to how much you can remodel to be able to stay in your home. A growing trend among the older generations is to have an ADU in the backyard, and that will have a lot more aging in place or universal design features so you can stay longer. And then rent out the front home or have, younger generations live there, that kind of a thing. So that's really an exciting trend coming up. In August, reverse mortgages, and then September, estate planning, which we do every year and is super important. And then 1031s and planning for retirement. So that, and then November, at the end of every year, I do like, if I can, to do a home selling seminar and just talk about home selling as we prepare for the new year. So these are the tentative schedule. This is the tentative schedule that I have. I would say please find us on YouTube if you haven't already. Just type in Perisson Real Estate and you'll be able to find a copy of this video, this seminar, as well as several others along the way that we've done over the past 8+ years. And so hope that you will do that and subscribe. I think last check I was a little over 100 subscribers, so I was excited about that. I get excited about small things if you didn't notice. Please make sure that you're on our email list. And if you signed up for the seminar, you'll be on our email list. If you're watching the recording, I hope that you'll be able to sign up as well, so that you get updated in terms of we do a monthly market update as well as the announcements about our seminars. And the picture on the left is one of our one of our in-person seminars. And on the right is our ever popular annual shredding and e-waste recycling, which is my next announcement. So May 3rd is when we have set the date for our next shredding and e-waste recycling. That will be at Mills High School, as always, in Millbrae. It is an on-site document shredding and electronic waste recycling. So on-site document shredding and electronic waste recycling, it is free of charge, but we do accept donations to support Mills High School. And last year we were able to raise over $1,700. So hoping to be able to beat that every year. And so that is it for the for this evening. Thank you very much for joining us, and I do hope to be able to see you again in our upcoming seminars and wish you a wonderful year ahead.